So traditional roles in financial risk management, we're going to be focusing on risk managers, what we call the middle office. It's very old terminology, but banks used to have front office, middle office, back office. Back office was where the transaction processing, usually non-university graduates, would be dealing with all the paperwork. Now that back office has been completely replaced by computers. But the middle office, it's more a sort of 9 to 5 activity. That's the risk managers. They measure risk, monitor it, and control the risks of the traders. These are the people who earn a lot of money, but they work all hours of the day, burn themselves out by the time they're 40 and retire. And they control the risk by setting limits on their behavior. Traders are the ones that execute buy and sell orders in the markets. They engage in the real profit-making activities. Market making, for example, running and listing options, buying and selling options, or other instruments on exchanges, where it's their role to make sure that there's a lot of buying and selling. The market is deep and liquid. That's what market makers do. Speculation as well. They may take an unexposed long position on a futures contract just because they believe, they speculate that the price will go up. Arbitrage, buying in one market or one instrument and selling in another market or another instrument that are highly correlated and making money through that correlation, which is predictable and less than perfect. And finally, traders would also be hedging, particularly if they're running an options book. They would have to do hedging using the Greeks, and we'll be covering that in topic 7. We're not going to be covering what portfolio managers do, or auditors, or compliance officers, but I'll just mention them here because it's all part of risk management. Portfolio managers allocate assets to portfolios. They look at long-term strategies, and they also have to manage their risks to achieve specified risk-adjusted returns. So portfolio managers are a little bit more advanced in many ways than risk managers because they also have to choose the assets that go into the portfolios. In fact, they usually delegate the role of risk management to somebody else, and they just take the risk measures from another desk in the hedge fund or pension fund or wherever it is. Auditors examine balance sheets, banking books, trading books to ensure accuracy and integrity. So banking books and trading books from banks contain different types of instruments. For example, loans go into the banking books, derivative instruments go into the trading books, but they are not entered in the balance sheet, for example. So if you are studying accountancy, you'll know more about this, but not everybody in this module is, so I'm not going to be looking at auditors' roles. And compliance officers too, they work with the auditors and risk managers. They just make sure that everybody's complying with laws and regulations. Now let's focus on risk managers. If you were to get an entry-level role in risk management, what would you be doing? Well, first of all, you start off with the monitoring of P&L, profit and loss, every day. So you'd look at the positions as they are in the morning when you get in, you compare them with, say, 24 hours ago. Some positions made a profit, others made a loss, and then you would do an aggregate P&L, but you would also disaggregate that P&L into different portfolios. Daily monitoring of risks usually involves calculating something called value at risk, or VAR, and we'll be going into details about the different type of models that you can use to calculate value at risk in topics 3 and 4. And then 5, 6, and 7 look at particular types of portfolios, and we apply value at risk to those. Reporting to the board. detailed breakdown of risk exposures is at a more senior level, if you became a senior risk manager, and implementing procedures to limit losses, for example, stop loss limits. These are the things that you would say to traders that they need to put on stop losses, or they, for example, if they're options traders, they need to limit their delta, gamma, vega, Greeks. These are exposures to different types of risk factors. They need to limit those too. And then there's the independent validation of the risk models, including the back testing of the risk models. And that is something that you could be involved in at a fairly early stage in your career. Independent oversight of trading activities, including stress testing, different desks, looking at the swaps desk or the loan desk, or the various desks in the company, and implementing stress tests and other types of scenario analysis. What would happen if we rejoined the EU, for example? There's a lot of stress testing going on before we left it, of course. And then finally, this is probably the most difficult activity, is the independent validation of traders' pricing and hedging models, because these can be very complex. They require deep mathematical understanding. Don't forget that these traders in the front office, these are the rocket scientists that have their own proprietary trading. A lot of them would be nowadays using high frequency algorithms, and you as a risk manager would need to understand how those models work and validate them and say, well, are they built on sound logic? Are they immune to breakdown? Are they going to create a huge amount of loss for the company or the bank? So that's one of the most advanced roles, most difficult of all. Now, when you're a risk manager, you need to not only measure your risk overall. Say, if it's a large bank, it's going to have desks of equities, it's going to have desks of bonds, of commodities, and all sorts of foreign exchange, loans, and so forth, swaps, etc. And you need to, if you're reporting to the board, come up with one figure about these are our risks, and so this should be the amount of capital reserve that we keep in safe place in case the worst happens. But also you need to attribute that into the different desks, the loan desk, the swaps desk, the equity desk, and so forth. So to understand that, let's go through some basic terminology that's important to understand. What is a risk factor? Well, it's usually a major market indicator. It could be a stock index like the FTSE 100 or the S&P 500, or a bond or a commodity index. It could be a currency, for example, or an exchange rate, the dollar-pound exchange rate. It could be a yield curve of interest rates like the gilts, the Bank of England bonds, the gilts curve, or the Treasury curve. The Federal Reserve in the US has a Treasury bonds and notes, and it's a curve because there are different maturities. You've got the very short-term Treasury bills up to about 90 days, and then you have Treasury bonds, and they go up to 100 years now, the US government shunting off its debt to future generations. Systemic risk is the risk associated with the dependence of a portfolios on changes in its risk factors. So the idea of risk management is to allocate a bunch of risk to the FTSE 100 and a bundle of risk to the S&P 500 and so forth. And that's not going to be perfect, because if you've got a portfolio of 100 stocks in the S&P 500 and then you attribute that to the whole 500 stocks, and you don't hold all 500 stocks in the proportions of the index, then your portfolio has something called a beta. The S&P 500 index goes up, and your portfolio may or may not go up. And if so, does it go up more or less? It's got to be bigger than 1 or less than 1. Is it more or less sensitive to that risk factor? And all the other types of risk factors have exposures which are measured by sensitivities. So it's called a beta for a share portfolio, but it's called a present value of a basis point, PVO1, very long terminology. That's the sensitivity of a fixed income portfolio of bonds or loans or swaps. That's what we call a fixed income portfolio. So anyway, systematic risk is the risk associated with the risk factor, but it's not perfect. There's always a residual risk. So if you've got a simple portfolio, just 100 shares in the S&P 500, then you've got its systematic risk, which is going to be the beta times the risk of the risk factor of the S&P 500. That's the systematic risk. But you've also got the residual risk, which is not captured by the risk factor as well. For example, if the entire UK LIBOR curve, actually LIBOR doesn't exist anymore, it's changed. I'll rectify that in future, but not on this slide. The London interbank offer rate has now changed to a different benchmark rate. But anyway, that's a yield curve. If it were to shift up by 10 basis points, by how much would the value of my interest rate swaps portfolio change? That's a question that, when you answer it, would attribute the risk to the systematic part of the risk, because the systematic part is captured by that risk factor, in other words, the UK LIBOR curve. Now, when you've got a very, very large position, not just shares or bonds or swaps, but lots and lots of different assets and instruments, the risk factor attribution is the act of mapping your total systematic risk to different components, to the equity component, to the bonds component, the commodity component, to the forex, foreign exchange component, and to decide how much each type of risk factor contributes to the overall risk of this entire portfolio. And as I mentioned, with the example of the 100 stocks in the S&P 500, specific, also called residual or unsystematic risk, is the part of the portfolio risk that's not attributed to changes in risk factors. And we don't mention that to the board. We only report the systematic risk. The systematic risk is what risk managers really focus on. The idea of taking diversification. So for example, you may have 100 stocks of the S&P 500, but you also may only have 50 shares in of the FTSE 250, or a handful of shares in the CAC 40 and so forth. And the idea is that those specific risks will offset each other. So while the American part might go up, the British part might go down, and the French part go up, or something like that. So they offset each other. So we're not too concerned about the specific or unsystematic risk. But for the capital reserves, there can be an add-on for those. But when it comes to day-to-day management, we don't worry too much about them. So aggregating risk, not adding risk. You don't just add up like you would in a sum. You don't add up risk, you aggregate risk, and it has to take account of correlations. So a large bank or corporation will have thousands of positions: equity, currency, bond, commodity, derivatives exposures. And very large portfolios, they can be divided into smaller portfolios. For example, you might have a large equity portfolio, but then there's the UK, the US, the European sub-portfolios as well. And we can go more and more granular if we like. For example, within the UK, that portfolio could be divided into sectors, pharmaceuticals, banks, utilities, and so forth. So however granular you want to go, you can measure risk at the very granular level and then aggregate. So within the UK, we could have a look at the pharmaceutical sub-portfolio risk and the utilities sub-portfolio risk and the banking sub-portfolio risk, right? They have their own. And so the people in charge of that particular investment in pharmaceuticals know what their risk is. And then you have to aggregate them into a UK equity risk. But you don't just add up the individual risks, you have to take account of correlation, and we'll explain how to do that in detail. So you could even go down to the trader's level. You could even look at, for example, the person who is trading particular types of pharmaceutical stocks, for example, and analyze, maybe the risks are particularly high with pharmaceutical companies, as we know, with the recent limits on the tariffs of pharmaceutical exports have really damaged UK pharmaceutical stocks. And so you may be taking a particular focus on the limits that trader can take when it's rebalancing the UK pharmaceutical stock portfolio. And that's it for this video and for this first part of the Topic 1 lecture. Bye for now.